Welcome to Breaking News to Trading Moves.
We're looking at a pretty specific transaction in the energy sector today.
Yeah, this one really caught our attention. It's a story about hardware, heavy metal, and just the core mechanics of the offshore drilling industry.
It is, and
Hmm.
it's a classic example of consolidation. When two massive entities decide to join forces, it changes the calculus for everyone else in the water.
Right, from the competitors all the way to the customers paying the bills.
Exactly.
So let's lay it out. The headline here is the acquisition of Valaris by Transocean.
To be clear, Transocean is the one doing the buying here.
Okay, so let's get the identifiers out there so everyone knows who we're talking about. You've got Transocean, which trades under the ticker RIG.
RIG, yep. And then you have Valaris trading under VAL.
And this isn't a small purchase by any means. We're looking at a deal value of approximately $5.8 billion.
It's a substantial number.
But the thing that stood out to me was the structure. There's no cash changing hands here.
That's right. It's an all-stock transaction, purely an exchange of equity. Transocean is basically using its own shares as currency to buy Valaris.
So when you combine Transocean RIG and Valaris VAL, what are we actually looking at in terms of, physical scale? Because in this industry, size really is steel in the water.
You're looking at the creation of the largest publicly traded offshore drilling contractor, period. The combined entity is going to have a fleet of 73 rigs.
73. That sounds like a lot, but help me understand what that actually means. Are these all the same kind of rig, or is there a mix?
That's a crucial detail. It's not just the number, it's the capability. Transocean has always been the heavyweight in ultra-deep water.
Okay, so the massive drill ships.
Exactly, the ones that operate in thousands of feet of water, often in harsh environments. Valaris, on the other hand, brings a very strong fleet of jackups.
Those are the rigs that stand on legs in shallower water.
Right, along with their own floaters. So by combining, they're creating a kind of one-stop shop for offshore drilling.
And beyond the hardware, there's the financial backlog to consider.
A huge part of it. The combined company will have an industry-leading contract backlog of roughly $10 billion.
Wow. And that's future revenue that's already signed and sealed.
It is. It gives them a lot of visibility into their cash flow for the next few years.
So I have to ask, why now? Why does this deal make sense at this specific moment?
To understand the why, you have to look at the last decade. The offshore drilling sector is in a multi-year recovery phase. But, recovery implies there was a sickness.
And there was. You're talking about the crash.
Yes. After the oil price crash around 2014, the industry basically went into survival mode. For years, nobody was building new rigs.
They were scrapping them, weren't they?
They were taking perfectly good steel and sending it to the junkyard because it was just too expensive to maintain when no one was drilling.
So we effectively hollowed out the global supply of these rigs.
We did. A massive amount of supply was removed. But now, demand is coming back. The world needs oil, and operators are looking back to the ocean.
So if demand is back, why not just build more rigs?
You can't just 3D print a deep-water drill ship. These things cost hundreds of millions of dollars, take years to build. And frankly, the shipyards aren't really set up to build them at scale anymore.
So supply is just tight.
Extremely tight. And that drives the economics. Day rates, the price a company charges to rent a rig for a day, have been rising sharply.
That's the demand signal.
Right. But because supply is so constrained, the drillers suddenly have the upper hand.
So the goal of this consolidation is to tighten that market even further.
That's the strategy. It improves pricing discipline. If there are fewer competitors bidding on a job, the price tends to hold up better.
Let's talk about how management is selling this. What are they promising their shareholders?
The pitch is built on synergies. They're promising meaningful cost savings.
Makes sense. 2 headquarters, 2 HR departments.
All that duplication. By merging, they estimate synergies in the hundreds of millions of dollars through 2026.
And that's real money that goes straight to the bottom line.
It is, and they need it. The financial strategy also includes a path to lower leverage over the next 2 years. Transocean has historically carried a fair bit of debt, so this is a big part of the narrative.
How did the market react when the news dropped?
It was a split reaction, which is pretty standard. Valaris, ticker VAL, jumped immediately because of the premium paid for the shares.
And Transocean?
Transocean, ticker RIG, stayed roughly flat. The market is kind of digesting the dilution from issuing new shares against the long-term benefits of the merger.
Okay, so that's the deal. But a move this big creates winners and losers well outside of these two boardrooms. Let's walk through who stands to benefit and who might be feeling the pressure.
Let's start with the winners. The most obvious group is their peers, the other offshore drilling contractors.
Right, Group 1. The logic here is a rising tide lifts all boats.
That's it, exactly. If Transocean and Valaris stop undercutting each other to win contracts, the floor for pricing just goes up for everyone.
So higher day rates.
Higher day rates and longer contract durations. If you're an oil company and you see rigs are scarce, you're not going to rent one for 3 months. You'll lock it in for 3 years.
So who else is in this winning circle besides RIG and VAL?
You have to look at Noble Corps.
That's ticker NE.
Right. NE Noble has already done some consolidation of its own. Now they get to sit back and watch their main competitors merge, which likely removes a lot of aggressive bidding from the market. They get the benefit without the headache of integration.
Okay, let's move to Group 2 of the winners.
Mm.
The offshore oil field services companies. Help me understand the distinction here between drillers and services.
Think of the driller, like Transocean, as the company that provides the truck. They drive the rig to the location and punch the hole in the ground.
Okay.
But that's just the start. To actually get oil out, you need a whole other set of experts to cement the, well, lower sensors, install subsea valves.
So the driller is the landlord,
Yeah.
and the service companies are the contractors doing all the work inside.
That's a great analogy. It's what we call pull-through demand. If more Transocean rigs are working, they pull demand through for the service company.
If you can't have one without the other.
Exactly. So increased offshore development lifts orders and pricing for them.
So who are the big three we should be watching here?
First up is Schlumberger.
Ticker SLB.
They're the giant in this space. Then you have Halliburton.
Ticker HAL.
And finally, Baker Hughes.
Ticker BKR.
All three have massive offshore divisions. If Transocean is busy, SLB, HAL, and BKR are busy. It's a very direct correlation.
All right, that brings us to Group 3 of the winners. The offshore exposed E&Ps and deepwater developers.
E&P stands for exploration and production. These are the operators, the companies that actually own the leases and sell the oil.
Now, this seems a little counterintuitive. If the drillers are charging more, why would the operators be winners?
Well, it depends on which operators you're talking about. For the developers trying to get a project off the ground, certainty is worth paying for. A healthier rig market accelerates final investment decisions, or FIDs.
And FID being the moment the board says go build it.
Right. They only do that if they're confident the supply chain works. A fractured, bankrupt drilling market makes them hesitate. A stable market keeps development pipelines moving.
So it's good for operators with big offshore inventories who need reliable partners.
Exactly. If you're sitting on a massive oil field, you want to know a strong, solvent contractor is there to help you get it out.
Who fits that profile?
Companies like ConocoPhillips
Ticker COP.
and APA Corp.
Ticker APA.
Both have a lot of exposure to offshore development. A stronger Transocean is actually good for their long-term planning, even if it costs a bit more in the short term.
Okay, so those are the winners. Let's flip the coin. Who's on the losing end of this?
The first group of losers is actually a different subset of those same operators. We'll call them Group 1, the offshore operators with big drilling budgets.
The super majors.
Yes, the companies that have fleets of rigs contracted at all times.
Why are they losers here?
It's pure cost. If this consolidation reinforces pricing discipline for the drillers, then the customers, these operators, face higher contracting costs, period.
So ExxonMobil and Chevron are looking at a higher bill for the same service.
That's it. If there used to be 5 companies bidding for their contract and now there are only 3, the price is going up, that pressures their project economics.
Let's name them. ExxonMobil.
Ticker XOM.
And Chevron.
Ticker CVX. These giants have enormous drilling budgets. Even a small percentage increase in day rates across a global portfolio is a massive hit to their expenses.
That makes sense. Okay, what about Group 2 of the losers? Land drillers and shale-adjacent names.
Right, we're leaving the ocean and going onshore for this one. This is really a story about capital rotation. Investors tend to chase momentum.
And right now, the momentum is offshore.
Correct. For a long time, shale was the darling of the energy sector. It was fast, it was cheap. But the offshore cycle is a longer, bigger game. As investors move toward that, land-focused drillers might get less enthusiasm.
So it's not that their business is failing, it's that their stock might just be ignored.
Precisely. It's about relative performance. They might see less pricing momentum than their offshore peers because the big money is betting on the deep water recovery.
Who are the names that might get left behind here?
You're looking at companies like Helmerich and Payne
Ticker HP.
and Patterson UTI.
Ticker P10.
Again, great companies. But if the market narrative shifts entirely to offshore is king, They'll struggle to attract that same level of investor attention.
Okay, we've covered the winners and losers, but I want to circle back to the main characters here. Transocean and Valaris. We listed them as winners, but there have to be risks, right?
Oh, absolutely. We have to look at the specific risk watch for the combined company.
Hmm.
Mergers are never as easy as they look on a spreadsheet. The first big hurdle is just integration. You're taking two different corporate cultures, two different safety protocols, two different IT systems.
And trying to mash them together while managing 73 rigs scattered all over the planet.
It's a logistical nightmare. If they take their eye off the ball to focus on the merger, operations could slip. And in this business, if you screw up, you lose the client.
And what about those synergies they promised?
That's the execution risk. Promising savings is easy. Achieving them without breaking the company is hard.
And finally, the balance sheet.
This is the big one for Transocean, ticker RIG. They have a lot of debt. They're betting the cash flow from Valaris, VAL, will help them pay it down. But if day rates stall or if integration costs more than they thought,
That deleveraging path gets rocky.
very rocky.
So for the listener watching this play out, what should they be looking for? What are the signposts?
3 specific things to watch. First, synergy updates.
We need to see the receipts.
We do. Look for details on cost savings and the integration timeline, specifically through 2026. Are they hitting their targets? If they stop talking about synergies, that's a bad sign.
Okay, what's second?
Pricing power confirmation. You need to monitor the commentary around day rates,
We need to see if the rates actually go up because of this.
especially for ultra-deep water and jackup rigs. Listen to their earnings calls. Are they announcing new contracts at higher rates? If rates stay flat, the thesis is flawed.
And the third thing,
The balance sheet. Watch the pace of deleveraging.
how fast are they burning down that debt?
And watch the trajectory of their interest expenses. If they can refinance their debt at lower rates because they're a bigger, safer company, that's a huge win.
So it seems like a high-stakes game. They're going all in on this offshore recovery.
They are, and it really leaves us with a final thought to consider. Are those projected synergy targets actually achievable in the timeline they've set out?
Given all the complexities of integration we just talked about.
Right. Integrating 2 massive fleets is messy. The history of mega mergers in this space is full of companies that got bigger, but not necessarily better or more efficient. The market is assuming this will work, but the execution risk is very real.
It's one thing to buy the rigs. It's another thing entirely to run them profitably.
Exactly.
Okay, before we sign off, we need to handle the housekeeping.
Of course. This content is not financial advice or a recommendation to buy or sell any securities.
This is purely the opinion of the author. We're here to break down the news, not manage your portfolio.
Always do your own research before making any investment decisions.
So we've walked through the deal, the market context, the winners in drilling and services, and the potential losers on the operations and land drilling side.
We've highlighted the very real risks of putting these 2 giants together.
Transocean and Valaris are betting on a tighter, more profitable future for offshore drilling.
Whether they can pull it off remains to be seen. We will be watching.
Thank you for tuning in to Breaking News to Trading Moves.
We'll see you next time.